Hello and welcome to the latest edition of the LPL Market Signals podcast. Jeff Bookbinder here, your host for today. I am proud to be joined by my friend and colleague, Barry Gilbert. So Barry, good morning. How are you today?
Good morning, Jeff. Doing well this morning.
Wonderful, wonderful. We got a action-packed agenda for you today. So let's get right into it. But before we get started, I do want to mention to everybody listening that maybe you're getting a little bit of a fatigued version of myself and Barry because we were up late watching that football game last night. And while it was a little painful for me losing my fantasy football matchup in the LPL Research League, what an entertaining game to see the Raiders win in overtime.
Yeah, great game. Great all weekend to see fans back in the stadiums. Just part of the slow return to normalcy. We were hoping to be a little faster, but I think people need to keep in mind the direction's the right direction still, and we saw a little bit of that this weekend.
Oh, absolutely. And for those who didn't see it, maybe the highlight of the weekend of football was the cat that fell from the upper deck at a Miami football game, a college game, and actually was caught by some people with an American flag. So how patriotic is that on the weekend when we remember 9/11 to save a cat's life falling from the upper deck of a game? That was neat. If you didn't see that, check that out on YouTube. So here you're, for those of you watching on YouTube, you're seeing our agenda for the podcast today. We're going to start by talking about all the policy goings on in Washington. So there's a few elements to that. There's the infrastructure spending package, which is really two packages. And one of them, the biggest one, isn't really infrastructure. It's more social programs, but nonetheless, human infrastructure. A lot of the Democrats are calling it. Of course, the tax hike, something that I'm sure a lot of you are a little bit nervous about as we get more into the negotiations for that spending package. Number three, the debt ceiling, deal or debacle, certainly has the potential to cause some market volatility. So we'll talk a little bit about that. And by the way, we focused on these issues in the weekly market commentary that's available on LPL.com. And then at the end, just a couple quick hits on inflation. We got CPI today, Consumer Price Index, which was good news. And then we got the Fed Beige Book, which is a survey of conditions on Main Street. Barry did a blog on that on LPLresearch.com. So we'll just hit a couple of quick takeaways on that before we wrap. So, but first, as we always do, just some quick thoughts on the stock market here. So Barry, we've tested the 50-day moving average again. It appears after 5 straight down days last week. We stopped that losing streak on Monday. And as we're recording this on Tuesday, stocks are a little bit higher. But that 5-day losing streak was only a drop of about 1.7%, which you can't even call a pullback here. What are your thoughts on what we've seen out of the stock market here over the last week, Barry?
Yeah, it's normal. It's even healthy to have those kinds of declines. 5 days, that doesn't matter all that much. It's the size of the move, and we've tested this trend line before. We were just moving back towards it. Keeps the market from moving up too fast. So I know it's strange to say, but I actually kind of like it. 5 days in a row, that's not a concern at all. And we did break that streak. We broke it on Monday. So the market went up, not a whole lot, but just a little bit. We talked to our technical analysts, and they would say that that trend is still in a good place.
Yeah, absolutely. That 1.7% is actually a lot less than a typical 5-day losing streak. The average 5-day losing streak brings the S&P down about 5.5%. So that just puts it into context how modest that decline was. We still think stocks can go higher over the balance of the year, but no doubt we recognize the risks. One of them we're going to talk about here in a minute, which is taxes. But you also have the Federal Reserve positioning to potentially remove some of its stimulus. And then we're in the seasonal weak period for stocks, historically September and October. So we would anticipate a little bit of a bumpy ride in the near term, but still we think we'll end the year a little bit higher than where we are today. So that's just a quick stock market update. Let's get into the policy, which is where we want to focus. So first issue, Barry, is the debt ceiling. I think we can move through this one really quickly because, frankly, we don't believe this is anything for investors to worry about.
No, the consequences of violating the debt ceiling are just too high, and everybody knows it. So there's a lot of politicking around it, a lot of playing political chicken. The Republicans want to force the Democrats to raise it on their own. The Democrats want to have a bill that the Republicans will have to get on board with. But when it comes to whether or not the debt ceiling is going to get raised, we think it's extremely unlikely that they wouldn't do it. Consequences are just too high.
Absolutely. So any volatility around this would be, we think, short-lived. It's really just Congress approving spending that's already been, gone through Congress. So don't worry about those headlines. We do, however, have to worry a little bit about tax headlines, and boy, are there a lot of them. So we'll hit maybe the top 5 or 6 pieces to the tax reform that Democrats are going to move through with reconciliation only requiring 50 votes. You see here this quote from Ben Franklin. We've all heard it, right? The only thing, there's nothing more certain than death and taxes, right? And so certainly we're going to get more taxes. It's almost a certainty, but there's a lot of questions about just how much higher and which kinds of tax increases that we get. So Barry, why don't we start with the corporate rate? That's certainly a biggie. The rate's not 21. They're proposing to Biden proposed it to go to 28, but the House plan just came out, is looking at 26.5. Where do you think that shakes out?
Yeah, the House Ways and Means Committee, in order to move this bill forward, actually had to start providing some details on what exactly the tax plan was going to be. They targeted 26.5%. This is still a negotiating position. There's still going to be a lot of work done on the bill. The moderate Democrats are still going to have a lot of say. I think it's going to come down from here. This leaves a little bit of room for horse trading, which is just part of the legislative process. So probably in the end, we think closer to 25, but we're already off that to 28. And even at 26.5, it is a hike that does create risks for businesses. But at the same time, historically, it would be one of the lowest rates that we've ever had.
Yeah. So, why this one's important. All these tax increases are important. We're talking about trillions of dollars of tax increases that have been proposed. Now, in the end, we'll probably get something closer to $1 trillion rather than 2. But one of the reasons corporate taxes are so important is because it comes out of S&P 500 profits, which is how we value the stock market, right? And so our forecast for S&P 500 profits in 2022 is $218 a share. There's a little bit of a tax hike in there, but if we do get that full 25% rate, we'll say, and we're likely to see an increase in foreign taxes that U.S. multinationals pay, that could take the S&P 500 profit number down about $10 in 2022. So this is certainly something meaningful for investors to watch. Now, you might see the strength of the economy as the reopening continues and the strength in corporate profits that we're seeing now continue. It could potentially offset some of that. So we're not necessarily going to take our number down from 218 to 208. But certainly we would say there's a little bit of a downside risk to our forecast if we do get all of these proposed, or most of these proposed corporate tax hikes. Now, the other biggie, or actually there's really two biggies, individual rates, certainly, and capital gains. So it looks like the top capital gains rate, if you include the investor's surcharge tax from the Affordable Care Act, could be around 30%. That's a really important number, of course, for investors. And the question, Barry, is, well, if investors see that the capital gains rate's going up, are they going to sell a lot of stocks ahead of that, driving volatility? What are your thoughts on that?
So, some investors would. Some investors who are long-term investors might just wait it out because chances are these rates will change again over the years. But there's a bit of a sneaky move here where the House Ways and Means Committee, when they released their cap gains number, and this was substantially lower than President Biden's initial proposal. When they released the number, they practically said that number will be effective as of this release, which means as soon as the number went out, people saw it, it wouldn't be possible to get the lower rate by selling immediately, a way to take some of the potential volatility that you might get from this move off of the table. Kind of an interesting move. Part of the headline here is how much lower this number was. I think one of the takeaways from all of these numbers is that we do see the influence of the moderate Democrats, if we're going to continue to see as this bill moves forward, because the Senate needs every Democratic senator on board to pass this. Gives the centrists a lot of power. We already see things moving that way directionally. And that means that the market, I think, was a little bit reassured by these numbers, because what we're getting is in line with their expectations. But completely agree with you. We're really interested in what's the market impact here, not the political implications and the economic implications, only to the degree that they influence markets. And the main risk is really around what those corporate tax rates are going to be.
Yeah, absolutely. So historically, stocks have handled increases in capital gains taxes fairly well, and corporate taxes. We included that in our mid-year outlook 2021 publication, a study showing that generally stocks hold up okay, and the exceptions are around major market disruptions unrelated to taxes, like 1987 or wars, things like that. So given the macro picture today, we would think stocks would be in a very good position to withstand tax increases. So I guess just running through some of these other increases, we're likely to see the top income rate go 37% to 39.6%. By the way, during the campaign, Biden was talking about $1 million in income as a break point. Now we're hearing more about 400,000 as a break point. So that'll be very interesting to watch. That would lower the break point for the 37% rate now, which I think is over 500,000. So that's certainly something to watch. They're talking about a surtax on individuals with income over 5 million. Carried interest, which is essentially allowing private equity folks to pay the lower capital gains rate as opposed to income tax rates. This is related to why you hear Warren Buffett, the capital gains rate too, but why you hear Warren Buffett talk about how his secretary pays more in taxes than he does. So they're trying to close that loophole. We might see the estate tax exemption breakpoint come down maybe to 6 or 7 million. That's something to watch. And then the SALT, state and local deduction cap for property taxes. That's a big one on the coasts. It's not in this, but it'll probably get added in horse trading. So look for change on that. That probably affects some of you folks listening to this today. So I guess the last one, and then I'll throw it over to you, Barry, to see if you have anything to add. The part of the way that the Democrats are raising money to pay for their all of their spending plans is by trying to allow Medicare to negotiate drug prices. In fact, I think it's a $700 million raise if they can get this done as they proposed. Essentially, it would tie drug prices to costs in other countries, and we've all heard a lot about how other countries have cheaper drugs than we have. If they can get that through and drug prices fall, significantly, that not only is that going to raise some money for the federal government, but it's also going to be a hit to pharmaceutical companies. So that's something to watch too that may affect the healthcare sector. Some of this was expected, but we could potentially see a bigger bite maybe than some of the strategists were looking for out there, over the last several months. So Barry, any of that jump out at you, or anything that you think I missed that's important?
No, I would just say this is probably going to be the most important 4 to 8 weeks for the Biden administration's legislative priorities. Similar to President Obama as he was trying to get the ACA, also known as Obamacare, passed, similar to President Trump as he was trying to get the Tax Cut and Jobs Act passed. This is a really important period, and there's going to be a whole lot going on. That means a whole lot of news. Passions are going to get a little bit higher. And as investors, our broad advice here is to tune out a lot of the political news. We will be watching corporate taxes closely and how that evolves, but shouldn't have a large impact on markets. We think overall, as this bill goes through its process, just to pay attention to the longer run, the bigger picture around the economy. The economy right now, it's largely about the recovery for the pandemic. That's the biggest driver. That's still where our focus is. This is important, but it's a little bit in the background, and just maintain a sense of perspective.
Absolutely. Good advice there. I think the timing of the capital gains tax changes and the breakpoints for income and capital gains are probably the most important things to watch over the next several weeks. But nonetheless, regardless of what we see there, we think stock fundamentals are still good enough to keep us going higher. I'm really glad, by the way, that Barry, that we were able to do this segment on taxes without Ryan, because if Ryan was leading the call today, he would have put a picture of AOC's Tax the Rich gown from the Met Gala into this presentation. And I just don't want to deal with the hate mail. So we will keep going. Just check it out online if you haven't seen it. Is inflation peaking? I would say, Barry, that we got some evidence that it might be today, because we just got a consumer price index that was better than expected. What's your takeaway on inflation here based on what we learned this morning?
Yeah, I completely agree. At least from this number, we'll go month to month. But the transitory camp won with today's number, little bit below expectation. I took a bit of a look through just to find one interesting takeaway. The one that I got, used cars. That's been one of the areas where we've seen absolutely massive inflation, and it's one of these areas that was hit the hardest by the pandemic. And part of the argument for it being transitory, because we see these unusual effects. For the first time since February, the CPI number for used cars, the inflation number for used cars, actually came down. Now, that number, those prices, they're really high right now because they've been going up for a while, and they've been going up quite a lot. And so the fact that they came down a little bit doesn't mean that prices are suddenly low. They're still quite high, but it's a shift in direction. And it's a shift in direction for one of the things that really got impacted most by what was going on with the pandemic. That turnaround, I think, is symbolic of the overall direction that we are heading. It's going to happen slowly. It's going to take time, but we really just want to see the direction of inflation slowly moderating, slowly coming down. And today's number at least supports that.
Absolutely. We have some temporary factors still putting upward pressure on inflation, and yet the inflation numbers have gotten better the last couple of months. And the Fed's preferred inflation measure, the core PCE, we've got a chart up of the three main inflation indicators for consumer prices, actually, and producer prices, the PPI, the CPI, and the PCE. And they're all between like 3.5 and 4.5 on core, roughly. If you take the messages we got from the PPI and the CPI, which have already been reported, and you translate those over to the PCE, it looks like we're probably going to see a similar reading to last month, which is 3.6%. So that hopefully is the peak. We stabilize there and then start to move lower. And then we're not too far away from the Fed, where the Fed wants us to be. As those temporary factors, resolve themselves over the next few months, we think these numbers come down. And, I think you're seeing, based on treasury yields and the stock market, frankly, this, past couple of days, the market seems to be relatively comfortable with the inflation story. So I think that's probably all we need to say there, but no doubt good news on the inflation front this morning. So let's wrap it up here, Barry, with our last piece, which is just this Beige Book barometer from the Federal Reserve. I know the big picture here is that it's slowed a bit or softened a bit, but it's still really strong, really positive. But, you look at, sort of the individual comments from the different Fed districts, right? And I think, we've gotten some messages from Main Street that maybe fit with the inflation picture, right? We still got supply chain issues. We got tight labor markets. What are companies on Main Street telling the Fed?
Yeah, we look at, we do an analysis of strong words minus weak words, and that gives us our Beige Book barometer. Number is still fairly strong. Now, there are other words that we look at that are related to labor issues, supply chain issues, inflation issues. That number is extraordinarily high. But despite that number, the overall economic backdrop still remains positive. That's what we're hearing from Main Street. These are interviews with business owners, with bankers, local community leaders on the business side. Those numbers look pretty strong. We got a sentiment survey this morning. National Federation of Independent Businesses does a small business sentiment indicator, and it parallels us in a way because it was a surprise to the upside, and we watch small businesses very closely. They're really the heartbeat of the American economy. But at the same time, small businesses were expressing a lot of concerns about challenges being able to hire, being able to bring people in, and that's slowing down what they can do with the business. But the sentiment still edged up higher. This is a little bit like what we're seeing here. Sentiment overall on this level remains pretty strong, but we know we still have a lot of pandemic-related challenges. Delta is making some of those challenges, at least temporarily, a little bit more difficult, but we don't want to lose the big picture from that shift in expectations. Everything now is going to take a little bit longer than we initially expected, but the direction overall is still quite positive.
Yeah, it shouldn't be any surprise, Barry, that economic growth is slowing a bit. I mean, even if we didn't have the Delta variant, we would probably see a little bit of a downshift because we just had such massive growth in the economy in the earlier stages of the reopening. So, when you add in the Delta variant and then you add in the fact that a lot of the reopenings already happened, a little bit of a slowdown makes sense. But there's probably, we think another burst. Hopefully it's in Q4, but if not, maybe early 2022 when, we get the full reopening that maybe we thought we would have already gotten by now.
Yeah, and it's a positive backdrop for stocks if we have that kind of environment. And earnings have been incredible. You follow earnings extremely closely. We've had tremendous upside surprises showing the resiliency of U.S. businesses. We think that they're going to be able to navigate the Delta variant well, as they did with the earlier waves that we've had.
Agreed, 100%. Let's just end with what to watch this week. We just talked about the Delta variant, of course. We'll be watching that closely, unfortunately, for the next several weeks to see what impact it potentially has on the economy. A lot of forecasters out there have taken their GDP forecast down from about 6% to 2%. I've even seen some a little bit lower than that. Of course, the third quarter is not over yet, but the Delta variant is absolutely having impact. Actually, you saw it in the inflation data too, with lower airline prices and hotel prices. Other than the CPI that we got today, retail sales for August is a big report that'll get a lot of attention. Consensus is for another decline after last month's decline. So we're coming off of a period where we had a lot of stimulus and reopening spending, and now and back to school spending. Now we're seeing, the Delta variant have more impact, unfortunately. And we're sort of past this wave of consumer stimulus, which could potentially weigh on retail sales again in August. So we'll see. We'll see what happens there. I believe that report's tomorrow. And then sausage making in DC, which we, of course, spent a lot of the time on this podcast talking about. That is the topic, again, of our weekly market commentary this week. We're not going to know exactly how this is going to shake out for a few more weeks, but certainly when you follow comments from moderate Democrats, that gives you an idea. Sinema, certainly Manchin. I think of the latest one I saw was Tester.
Those are the three. Those are the three biggies.
Those are the three biggies, right? You're seeing comments from these people digging in and sort of setting the boundaries. That tells you maybe where we're going to end up, because the progressives don't want to cause this to unravel and hurt President Biden. So that's that. Lot to watch this week, certainly. So we'll, as we do every week, continue to digest all this and keep you posted on what's going on every week on LPL Market Signals. So with that, thank you for joining. Thank you, Barry, for co-piloting. We will be back with you next week, where Ryan's return. He'll be back. He does just a spectacular job hosting this. So I definitely am excited about having him back, even though Barry certainly did a great job walking us through all those really important issues for investors to follow in not only in Washington, D.C., but in terms of inflation as well. But Ryan really makes this fun. So we'll be excited to have him back. He's traveling this week. So with that, I'll go ahead and sign us off. Thanks, everybody, for listening to the latest edition of LPL Market Signals, and we'll see you next week.